I think it's critically important, Jeff. I think what you've seen over the course of the last 8 weeks is a level of fiscal imprudence, and I think it's critically important that the Chancellor today lays out a clear path of fiscal prudence. We understand from numerous sources that the 50 to 60 billion pound deficit that they want to cover, that's about 1 to 1.5% debt to GDP, is going to be addressed today. And I think it's of critical importance that we see a high level of fiscal prudence and bring confidence back to the UK gilt market, as has really happened since the change in Chancellor.
We've come into this announcement with a very hot CPI print, over 11% here, which again just puts further pressure on UK consumers. Is it necessary to have this degree of austerity at this point in an economic cycle where consumers are already being hurt by high energy prices that are generating these high CPI prints?
Well, I think it's very important that the Bank of England demonstrates that it is committed to reduce inflation. That has to be the most important factor, not only for the Bank of England, but central banks broadly. And I think that you've seen in the commentary from the Governor his intention to address the inflationary biases that we're seeing in the marketplace. I think the general expectation is that we will see another 50 basis points in December. But I think also you will see the Bank of England slow that path. You heard that from the Federal Reserve last week, that there is a likelihood of a slowing of the path. But I think that it is important that the Bank of England demonstrates it's in front of a continued battle against inflation.
I suppose the question a lot of our audience will be asking themselves is how attractive does the UK look at this point, given the fact that we're on the verge of what looks like quite a tough budget? And we know we've come through, as you pointed out, several weeks of market turmoil related to the previous mini-budget from the Liz Truss government. I mean, it's a market in terms of equities that looks relatively attractive on the multiples, but given the uncertainties about what this budget will do, what would your position be here at Barclays?
I think what we've seen in the course of the last month is a more responsible attitude to the fiscal position of the UK. And you've seen the gilt market react to that. 30-year gilts have traded from 5% to 3.5%. I think that's been extremely important that we got a level of confidence back in the bond market. The underlying equity market will be a reflection of the earnings power of the corporates within the mix of the FTSE through 2023 and 2024. Our research department are expecting a 5-quarter recession, really starting as we've seen in Q3 of this year into Q3 or Q4 of next year. But you will see a peak in interest rates. Our expectation is that you will see a peak in interest rates in Q2 of next year, which really means that the focus on risk assets, underlying equity assets, with the earnings power of the companies in the composite of the UK will come through in 2024. The market, you would expect to reflect that in the middle of 2023, but it's a long journey from here.